So in this session we will be learning about capital structure ratios or leverage ratios. Okay, so capital structure and leverage ratio, they are providing us insight of financing techniques. Okay, financing techniques means long-term financing techniques. Unlike liquidity ratio, which shows the solvency position for the short-term period, capital structure ratio will show us the solvency position for a long term. So financing techniques for a long term. Okay, so what does the capital structure means? What does the capital means? Okay, capital means long term finances acquired. So what will it include? It will include share capital, right? So share capital is basically divided into two types of shares: equity share capital, then preference share capital. Then you will have reserves and surplus. Okay, so this reserves and surplus is what accumulated profit, okay, which is reinvested in business. So all this put together, these are owners fund, right? This belongs to owners fund. Then there are something known as borrowed funds. Your borrowed funds will include long term loans. So loans may be secured or unsecured. Okay, so these loans can be obtained from banks, then by issue of debentures, etc. So all this is known as, put together, known as capital structure. So capital structure or a leverage ratio will help us to find out what is the long term solvency position of the organization. Okay, now let's learn first capital structure or leverage ratio, and that is equity ratio. Okay, so let's see one example and let's learn what is this equity ratio. So equity ratio is your owner's fund divided by your total sources of funds. Okay, so what does that mean? That means your owner's fund divided by owner's fund plus borrowed funds. Okay, so owner's fund, that means owner's fund will include equity shares plus preference shares plus your reserves and surplus. This divided by owner's fund. Again, this will include your equity shares plus preference shares plus reserves and surplus. Okay, then plus borrowed fund. What does borrowed fund include? Borrowed fund includes your debentures. Okay, then your secured loans plus unsecured loan. That is long term loans, right? Unsecured plus secured long term loan. Okay, the short term loans are always included in the current liabilities. Okay, so that won't come here, only long term. This is long term loans, long term borrowed funds. Okay, So basically, what does this ratio show? It shows the ratio of out of total sources of fund, how much is the owner's fund. That is, how much amount of owner's fund is included in the business. So this ratio has to be optimum. Owner's fund cannot be in excess, or owner's fund cannot be very less. Okay, so there has to be optimum utilization of both debt as well as equity. Okay, now let's see one example on how to calculate this ratio. So this is the example in the books of XYZ Company Limited. Okay, you have a balance sheet as on 31st March 2017. Then in that you have sources of fund, in that you have shareholders fund. Okay, then shareholders fund you have both, okay, equity shareholders as well as preference shareholders. Okay, this includes both your equity plus your preference shareholders. Then reserves and surplus. Okay, then total coming up to 8 lakh rupees. Then loans, both secured as well as unsecured loans. So that total comes to 3 lakh. Then total sources of fund is 11 lakh. Okay, then you have application of fund. Application of fund, in that you have fixed asset. So for fixed asset you have gross block less accumulated depreciation, net block. Okay, so net block is 4,50,000. Then investments, so these investments are long term investments. Okay, so that comes to 3 lakhs, right? Then your current assets, you have inventories 1 lakh, sundry debtors 1,50,000, cash and bank balance is 1,50,000, loans and advances 1,75,000, so 5,25,000. Then less current liabilities, you have sundry creditors provision 2 lakh, 2,50,000. Then 2 lakh and 25,000. So the net current asset comes to 3 lakh rupees, and miscellaneous expenditure to the extent not written off or adjusted is 50,000. So the total of application of fund comes to 11 lakh. Now we have to calculate your equity ratio. Okay, so let's calculate. Equity ratio is equal to owner's fund divided by total sources of funds. So that comes to owner's fund divided by owner's fund plus borrowed fund. Okay, so let's see in this case. Okay, what is the owner's fund? Owner's fund is shareholders fund plus reserves and surplus, that is 5 lakh plus 3 lakh. So it is 5 lakh plus 3 lakh. Okay, then what is owner's fund plus borrowed fund? Owner's fund is 5 lakh plus 3 lakh. Okay, so let's put the owner's fund for 5 lakh is your shareholder plus 3 lakh reserves and surplus, plus how much is the borrowed fund? Total of secured and unsecured loan. So 2 lakh plus 1 lakh. Plus 1 lakh. So this comes to 8 lakh divided by 11 lakh. Okay, so that comes to 0.7272 or 72.72 percentage. That means out of total sources of funds, 72.72% is the owner's fund. Okay, so if you see the liquidity position, long-term solvency position of this company, it's very good, right? They have enough owner's fund to cover their debts, right? 72.72 is owner's fund, so balance that 38% is a balance 28%. I'm sorry, 28% is the borrowed fund, right? out of total sources of fund. So their long-term solvency position is good. Okay, that's it about your equity ratio. Okay, so it is one of the important capital structure or leverage ratio. Thank you.